Is there a secret score that determines how big of a house you can get? Yes, and that is what we'll be diving into today. And I'll give you a hint, it's not a credit score. Hopefully everyone knows about their credit score by now. You may not know the exact ins and outs of how it gets calculated, but for the most part, it's pretty straightforward. There are plenty of resources to help you. I'll link some in the description. Additionally, I'll be doing a video all about credit and the various credit scores. Did you know that you have at least 3, and some people even have more? But the score I'm going to be talking about today isn't going to be on any financial app that you may have, because the programs that calculate it are proprietary AI-powered systems that comb through hundreds of factors to label your financial stability when deciding whether you qualify for a mortgage. These programs are known as AUS, or Automated Underwriting System, and the score I'm talking about is your DTI. What is DTI? DTI, or the debt-to-income ratio, is simply your total monthly payments paid to debt servicing divided by your total monthly income. Now, why is this so important? It's important because taken alongside other factors like your total income, various liabilities, credit score, and so on, your DTI provides a valuable metric for banks to gauge how likely you are to make good on your mortgage payment. Now, if you have zero debt and like one simple form of income with no investments or loans or credit cards of any kind, your DTI will be fairly simple to calculate. However, if you receive income from multiple sources, maybe you write off income for tax deductions, have rolling credit card balances, maybe some student loans and more, then your DTI becomes much more complex to calculate. For the vast majority of loans, an automatic underwriting system is used, so this calculation is more or less a cinch. Well, let's briefly look at some of the ways that debt can be calculated. Often, when people are trying to calculate their DTI, they'll give the loan officer the total debt balance. Now, don't get me wrong, this is useful because you can see the total debt burden that the person has, but for the purposes of calculating a DTI ratio, that's not really what's needed. What we're interested in is how much money every month is paid to debt. Now, this debt can be calculated different ways depending on what kind it is. Take, for example, student loans. When your credit is pulled, sometimes a monthly payoff amount is annotated on the credit report. This is the minimum that is due, and it's usually a low amount like $17 or $35. However, if there's no amount, or if it's just a zero, the lender will have to use a percentage of the total amount to calculate a monthly minimum. When using FHA or Freddie Mac, that percentage is 0.5%, but when using Fannie Mae, the number jumps up to 1%. That means if you have $50,000 in student loans, FHA and Freddie Mac will treat that debt as having a monthly payment of $250. $50,000 times 0.5%. But Fannie Mae would treat it as double at $500. And if you don't know what these terms mean, don't worry, I'll cover them in a future video. This means that even though using Fannie Mae may result in lower closing costs for some people, certain borrowers with high student debt may have to go with a program more favorable to their situation. Now, another common situation here is with installment loans. Installment loans are loans that are paid off in a set number of payments, like vehicle payments. Historically, when someone has 10 or less months on an installment loan, the loan underwriter doesn't have to count it toward their overall monthly debt payments, but lately some underwriters may use their discretion and count installment loans unless there are only a few months left. This is opposed to revolving credit lines such as credit cards. Now, the reason they're called revolving credit lines is because there's not a set date by which they have to be paid, and as long as you keep paying the credit line, they will keep extending it for you indefinitely. For this debt, the credit card minimum payment will be used to determine DTI. Lastly, but probably most importantly, is the DTI will include your future mortgage payment, which includes the loan principal, insurance, and interest. HOA is also lumped into this along with a few other fees, so it pays to pay attention to the final figures when seeing how much you can afford. Now, if all this seems a bit confusing, don't worry too much about it. A knowledgeable loan officer will be able to take care of a lot of the background calculations for you and let you know what you qualify for, and more importantly, how you can get to the goal by suggesting what debts to pay off to make your dollar go further. Now, if you already knew some of these tips, leave a comment below and let me know what you know. I'd love to see how knowledgeable the community is. That's all for now. Thanks.